when all is said and done, the Fed has a handcuffs on, and it's going to make it very tough for this economy. When we slip into a recession, we're not going to come out of it very quickly. And I've said this for a while. We're looking at a scenario where we could be in a recession for years, in fact, even if it's not a horrendous, nasty depression.
We're going to be talking about Bitcoin, markets, gold, and the latest economic data with Gareth Soloway, Chief Market Strategist at InTheMoneyStocks.com and President of Verified Investing Education. First, shout out to our sponsor today, iTrust Capital. It's an IRA that offers 35 crypto assets and physical gold and silver. iTrust offers 1% trading fees, the lowest in the crypto IRA space. If you're over 18 and you want to open a new account with cash or roll over an existing IRA account, click on itrust.capital/David to learn more and get started. Link in the description down below. And now on to the interview. Gareth, thank you for coming back. It's always good to see you.
Thanks for having me back. It's always good to see you as well. And I love your hair, man. It is point on point.
Thank you. It's ironic you said that because I didn't comb it properly today, unlike usual. So maybe I should just, let it go. I don't know if the markets have been letting it go. Let's talk about the markets. Last week on Friday, we're speaking today on the 9th of October. Last Friday, the jobs numbers came in hotter than expected. 336,000 payrolls added, which defied expectations of roughly 170,000. So beat it by almost double, Gareth. Now, interestingly, the markets, the stock markets at least, rallied on the news. In the past, maybe good economic data was bad news because the Fed would probably tighten on good news. But that doesn't seem to be the case. Markets rallied. And when I say let it go, it was letting it go onto the upside. What happened there?
Yeah, so believe it or not, it wasn't the greatest of jobs numbers. And I know the headline number made everyone say, wow, that's an amazing growth of jobs, 336,000. But if you actually go under the belly of it, it's kind of like looking at a car and saying, wow, that's a great car. And then you look under the hood and you're like, oh, this is a lemon. The same thing with this jobs report. And what I mean by that is that full-time workers actually declined while part-time had a major gain. And in fact, if you look at the last 3 months, full-time jobs gains are actually a loss. It's down about 600 and change thousand in full-time work. And what does that tell us, right? So it tells us that the underlying economy is starting to weaken. More part-time work is being taken on because they can't find full-time jobs. Then throw into that President Biden, I believe, had a press conference around 11 a.m. on Friday when the jobs number came out. And he actually said, expect to see weakness in the jobs market. So he's basically telling you what is coming. The numbers in the underbelly confirm that. And we saw the yields after initially popping on that jobs report and the dollar as well. We saw the yields coming back in and the dollar actually turning negative. So the market loves a lower yield and a lower dollar.
Why is it that even the government now is probably admitting, I don't know if that's the right word to use, but at least acknowledging that perhaps the labor market would cool down, even despite last week's numbers?
Yeah, so I think at least from a government point of view, it becomes very political and where, you don't want this to surprise people. And all of a sudden going into next year's elections, the unemployment rate starts to spike and people are losing their jobs. So what he's trying to do is he's saying, hey, listen, it's been a great run, but guys, we have to prepare. There's going to be a slowdown here. And he's doing that to kind of cushion the actual event so people aren't shocked when it actually comes. But it's coming, folks. I mean, it is coming. The fact that Jerome Powell, a couple months ago said he didn't see a recession, that's like the kiss of death right there. You definitely have a situation where Ben Bernanke did that in 2008, and look at what happened in 2008 and 2009. But again, the data out there is showing us that the economy is absolutely slowing.
So I'm just looking at this breakdown of the jobs report from last Friday. So last month, healthcare added 66,000 jobs, manufacturing added 17,000, and retailers added 20,000. Professional services added 21,000. Government at all levels added 73,000 jobs.
Yeah.
So let's talk about that. Government employees adding jobs was the biggest contributor to non-farm payrolls increase of 336,000. Is that what you're talking about? The government jobs being
Well,
being added?
no, yeah, actually, you have to dive in a little bit deeper to full time and part time. So a lot of the healthcare jobs are part time jobs as well, and so you have to go into that. But I think just the fact that the government is adding jobs, this also skews things, right? The government basically has a free paycheck at this point to add as much as they want. We've seen the U.S. deficit or the debt go up sky high, adding something like $500+ billion in a couple of weeks. We're now at 33.5 trillion. Now you throw in interest rates where they are, and ultimately this is putting us on a crazy crash scenario down the line in terms of how much debt we are taking on, and obviously the interest that we're paying. So you go to the jobs data, it is showing us weakness. We see the government doing most of the hiring. That's never a healthy thing. You want to see the private sector doing most of the hiring, and then throw in the fact that debt is soaring. That is not a good recipe.
So Mary Daly, she is the president of the San Francisco Fed. She said in at the Economic Club of New York last week that if we continue to see a cooling labor market and inflation heading back to our target, we can hold interest rates steady and let the effects of policy continue to work. First of all, I'd just like to acknowledge that they're kind of looking at, I guess, the same trend as you, and that even though last week's number was a big jump on paper, they're probably looking at behind the scenes, under the hood, and saying this is also cooling. So they're probably agreeing with you, Gareth.
Yep.
But my point is, so even the Fed, where members of the Fed is acknowledging a cooling labor market, what is their response in terms of monetary policy going forward?
Well, that's the $1 million or $1 billion or $1 trillion question, as it may be for the U.S. debt, right? So it's all going to come down to how fast the economy declines, right? So the Federal Reserve has made it very clear they're okay with a slowdown, a recession, in fact. But the question is, if it gets really dramatic, if we see a fall off a cliff type scenario where the stock market declines 20% in a month or two, where does the Fed step in? Now, they have raised interest rates to a point where they could cut a little bit. I talked about this earlier today, like a mercy cut, where they can't lower interest rates as much as they might want to because of inflation still being relatively elevated, but they could do something to just reassure the markets that they're willing to act. But when all is said and done, the Fed has a handcuffs on, and it's going to make it very tough for this economy. When we slip into a recession, we're not going to come out of it very quickly. And I've said this for a while. We're looking at a scenario where we could be in a recession for years, in fact, even if it's not a horrendous, nasty depression.
Now, do you generally agree with this statement, which is that the bond market is better at predicting recessions than the stock markets?
Yeah, I do. I actually agree with that. Absolutely. The bond market is generally better. It's a bigger market, more money involved in the bond market. You're talking something like 50 trillion in the US in the bond market alone. I think about 150 trillion globally in the bond market. So it is a bigger market. It's known as the smarter market. And I agree 100%. And speaking of which, take a look at this chart of the yields, the 10-year yields, and look at what we've seen. So I have a trend line that goes back to 2012 here, and it's really a beauty. And what we could see is every time we hit this line, there's a pullback, right? Pullback. Well, look at what we just did. We just pierced the line, and the yields are beginning to pull back as well. And so what this tells me is the bond market, even in spite of a strong jobs number where everyone was saying, wow, this is so strong, the bond market is actually sniffing it out and beginning to see a decline here in yields. And that, again, is a heads up.
Okay. The bond market, is that sniffing out an economic, actually, I was looking at this the other day and had this discussion with somebody else. Is the bond market, in fact, just what you're looking at, sniffing out an economic recovery? Now, in the past, sometimes when you see a big sell-off in treasuries and a big spike in yields like we've seen in the last couple of months, does that signal to you that the bond market thinks that things are going to get better?
Well, so I mean, for bonds themselves, right? Bonds have been cut. I mean, this is the other crazy thing. These banks out there, right? You're talking about all these banks, these regional banks, they have billions, hundreds of billions of dollars of these bonds on their balance sheets that are not marked to market. So they can keep them on there. But we have to remember that a lot of these bonds are down 25 to 50%. So I think I would expect bonds to rally as yields pull back. But I think the pullback in yields that we're seeing here on the chart is clearly telling us that the bond market is anticipating an economic slowdown, which would then kind of cap interest rates and maybe even start to bring them in just a little bit.
How's the yield curve looking? The 10-year minus the 2-year. If we take a look at that, you'll see that it's actually been reverting back to
That's right.
zero. Now,
Hmm.
I've mentioned this to you, I think, in the past that whenever, historically speaking, whenever the yield curve goes negative, it doesn't go in, the economy doesn't go into recession right away. It's only when it reverts back to zero
That's right.
that we start to see the Ember designated recession. That's exactly what's happening now. And, ironically, nothing's going on in terms of a recession announcement just yet.
Well, my guess is we're not going to hear the announcement on CNBC or anywhere like, "Hey guys, we're going to now have a recession." It's something that's going to naturally happen, right? But you're 100% right that the yield curve inversion is where everyone freaks out, and then everyone kind of becomes complacent. We saw this in 07, 08, right? Same thing. Ben Bernanke coming out saying, "Hey, we're not going to have a recession. We're not pricing that in." We saw that same thing with Jerome Powell a few months ago. But ultimately, it's the uninversion that is the trigger, or at least that coincides with the recession, and it is now quickly approaching. And you kind of throw together all of these economic numbers, the jobs numbers I just discussed about part-time versus full-time, and these other factors, and you could start to make sense of why we are likely in early 2024 to enter a recession. The question is, what's the stock market going to do, right? So right now, if yields pull back, the market actually wants that. And so we could get a short-term rally in the S&P and in the NASDAQ, but ultimately, at some point, if we slip into recession, the economy really takes a hit, earnings are going to take a hit, and the stocks are going to really take a tumble as well.
Now, Gareth, I want to come back to what you said earlier, which is that if we get a recession, you said it may last for years if we're not going to
Mm.
get a depression. Can you explain your logic here?
Yeah, so the thought process is this, is that if you go back to really 2009, every time the economy has even tripped, not even stumbled or fallen, but just tripped, the Federal Reserve has come out gangbusters with liquidity into the system. And that's always been okay because inflation has been essentially below 2%. Well, we're at a point now where inflation is elevated. We're seeing strikes all over the country, healthcare workers, UAW workers, all these workers striking. They're getting higher wages. That is also inflationary. So again, it's going to be one of these scenarios where, like I've said, and we've had this discussion for 6+ months, inflation is likely going to stay at 3% or above for the foreseeable future, which is going to make the Fed's job for cutting when they come to rescue the markets almost impossible. Can they cut? Yes, maybe once, maybe twice, throw a mercy cut out there, but they can't really take us back down to jerk us out of this recession. And I think that's the big issue here, is why it could last a lot longer. If you don't have the Fed intervening like they usually do, which is a gangbusters intervention, then recession may be in a store for a longer period than usual.
And just to add to that, I'm guessing you're also thinking that because the interest rate is going to stay higher for longer, people have more interest payments to cover
That's
down the
right.
line. That means their discretionary spending gets cut down if we assume their wages don't keep up to a rapid pace, right?
That's right. And we're seeing like personal debt, right? Credit card debt over $1 trillion, new all-time highs. We're seeing bankruptcy filings hitting new records as well. And I mean, there's so many of these underlying signals, even with the consumer still willing to spend and run up debt. But there's so many of these underlying signals that are telling us that people are really starting to struggle. In fact, I would argue that a good chunk of the population in the US already thinks or feels that they're in a recession. It's just the people that haven't had investments. If you've been in the stock market since last October, you're feeling pretty good. And I think that's kept consumer spending up. We've now seen a top out in that phase of the markets, and we're now starting to curl over. And if that continues, you'll see the recession feeling hit the whole majority of the US.
That's a good point. Can you just elaborate on this feeling that we get? I mean, we're not talking about data, we're talking about a feeling. When you're an average Joe, what needs to happen for you to make you feel like you're in a recession? This is an important question because
Right.
perception actually drives demand going forward. It doesn't matter if it's a reality right now, but your perception is important.
Yeah, so I mean, you could be talking about, having to pay student loans again. That's a tax essentially. You could be talking about just having interest rates be higher. I mean, how do people go out and buy a home right now? You look at where rates are and what the mortgage payment is on that same $500,000 house from 5 years ago to right now. It is insanely different. Inflation, right? Inflation is a tax, and so people are being taxed over and over again. Now, if you had stock market investments and you were riding them up all the way till the last month or two, you were probably offsetting that effect. But a whole portion of the population isn't able to offset that. And that's the population that's been feeling it already. Now you're probably going to go into the second phase, which is the stock market stops going up, which means everyone else starts to feel it as well.
So let's this is a good segue into stocks. Let's pull up an S&P 500 chart, Gareth, please. and we can take a look at the trend. The trend is your friend, except maybe now is not the time to be following the trend because the last couple of days has been just up. Is that your
Yep.
friend now? The trend is up. Follow the trend.
Well, short term, inevitably short term, you do get bounces. Like, just to look at this, we had a pretty dramatic decline from on the S&P from around 45.20 all the way down to 42.20. So that's a big move. That's about 7-8% on the S&P to the downside. So it's usual to get small bounces. But if you look at this trend line here, this was your trend line since the October lows of 2022. And that's the concerning part is we have now broken that to the downside, which means the uptrend has now broken. We've now started to make lower highs, right? Here's a low, here's an equal low, and now here's a lower low. Look at the highs, high, lower, high. So the trend is no doubt to the downside now. And I think it's because, again, reality is starting to set in that rates will remain higher for longer. The U.S. has a debt problem that is not going to go away, and that starts from the consumer and goes all the way through the U.S. government. And there's just underlying issues now with work.
I just want to bring something up. So you and I have been speaking quite a bit in the last 6 to 7 months. Now, you've been calling for a market correction for quite some time, even while the market was rallying to new highs this year. You did the same thing a couple of years ago when Bitcoin was at its near its all-time highs, and Bitcoin continued to rally, and you were calling for 20K Bitcoin, even around 60,000. Eventually, it went up to 69, and it came down. My point is, you've had a history of calling corrections right before the top. Now, is that like a consistent pattern for you? Like, you can, as a trader, sense that there's a top coming, and so therefore you're positioned to the short side before?
Well, yeah, I mean, I think that's part of it is that I've traded now for 24 years. So I've been around this. I've gone through so many. I've started out in the dot-com era with the collapse. So I experienced that 2007, 8, and 9 and all these things in between. So you start to kind of see the warning signs and you understand how human psychology works, right? People generally get off sides thinking something's not going to happen. And I would just like to point this out. This is a chart here. Like if we go here, this is the dot-com bubble on the NASDAQ. Look at the dramatic move up. Like if you told me this is the COVID low, I would actually believe you. It was a steep drop and then a big reversal leading into an epic bull market. This happened to happen, and this was 1998. Look at the formation: sharp up move, big pullback, big bounce, and then the bigger move came down. Now let's fast forward to the current period in the market. All right, look at this. Sharp up move off COVID low, pullback, retrace. And the idea here is that people's emotions tend to repeat. Is chances are you're going to head back down like that. So I actually think that within a year or so, we probably reattack the COVID lows. And again, that would be history repeating from the dot-com era. You can, by the way, find the same pattern replicating in individual charts in other markets. And again, human nature doesn't change. It's driven by greed and fear, and that's why it stays the same.
What's different this time versus, let's say, 2001? Any differences, major differences in the pattern of the chart?
Yeah, so the pattern is generally the same. The differences could be individual. For instance, inflation wise is obviously has been a lot of a different scenario. Granted, we had a little bit of inflation back then, but it's more what's driving it. But you could also look at similarities and say, look at what happened in 2021, the irrational exuberance that GameStop, AMC, crypto markets experienced. Many of these tech stocks going to ridiculous levels. That was all very similar to the dot-com bubble and what happened there. And by the way, if you look at Cisco was the equivalent of Nvidia back in 2000, and it became the biggest stock back then, market cap wise, shooting up. It was because it was in networking for the internet, and it was the only game in town. And by the way, if we flip over, and I got to show you this because I think it's just so incredible, is that if you look at this, and by the way, I'm not necessarily predicting Nvidia has made a top and won't see this for 20 plus years, but look at the run on Cisco, and then it has never gone back there again. And again, same exact scenario. This was the only game in town, the most exciting area like AI is to NVIDIA chips, right? And look at what happened to this. Look at the collapse and look at what happened since then. So there's so many eerie similarities. And this is why I love charting, is because, you're never going to be 100%, right? Charting isn't about that. It's about having the odds in your favor. And when you use history to guide you, you can see how things repeat over and over again.
What happened with Cisco at the end? Was that just a dot-com bubble bursting and it just popped everyone's bubble?
That's what it was. It had this crazy run up, a la Nvidia's type of move that was just parabolic, where everyone jumped in saying, "Wow, this is changing the world, and this is the only play in town." Right. So again, the only play in town, meaning that there weren't other networking stocks at that time that could compete, just like Nvidia with their chips. But we know what happened. Everyone else got into the space, their margins collapsed, and they've never seen those highs again. And that's what I fear for Nvidia, is that it's a great story now, and their margins will last for another year. But every other semiconductor stock out there is coming for their lunch. They're seeing the profits, and they are coming and making chips, or at least starting to make chips.
If somebody were to say to you, Gareth, I'm new to trading, I'm new to investing, isn't it just easier to go long and stay long and forget about it? I mean, why bother doing all this analysis and finding tops and shorting things when maybe they could go down? I mean,
Yep.
how would you respond?
Look, so I mean, I understand that. If you have a 9 to 5 and you have a family and you have no time to look at the markets, I think in general, I think that's doing yourself a disservice, because your financial future kind of depends on investing intelligently. But having said that, you shouldn't try to be a stock picker. You have to work at this. I mean, I've traded for 24 years, like I said, and I still get it wrong. And so I couldn't even imagine, going back to my early years, how many times I got it wrong and how much money I lost early on learning how to do this. So it's best to, again, stick with index funds and just slowly dollar cost average, because I do believe that we could drop 50% in the S&P 500. If you dollar cost average over the next 20, 30 years, you'll probably still do okay.
You're an advocate of, or I guess, do you like the idea of buying things on the way down?
I do. I do. If there's a fundamental thesis behind it, right? You just don't close your eyes and say, "Hey, I'm going to buy that because it's down 50 or 60%." If it's a company, a good quality company, like for instance, I'll show you guys some charts here. At least this is more for swing trading, but like if you look at Boeing, right? So Boeing on the daily chart, and this is more of just a daily chart, but just for a short-term bounce. I mean, look at how many down days you've had in Boeing here. You look at 3M, right? And 3M, to me, this is a stock that I'd accumulate. We go to the bigger time frame, it's back to levels it hasn't seen since 2004, right? So these are out of favor stocks that have collapsed, but they're good quality names. We know a 3M's not really going anywhere in the next 5, 10, 20 years. And so therefore, again, you get it at a discount. Now, it doesn't guarantee that in the next month you're going to make money, but I would say in general, over the next 5, 10 years, you probably will hang in there. They pay a dividend as well.
You mentioned, if the S&P 500 corrects 50 to 60%, you could be, you need to be prepared for that. I think you were talking
Yep.
hypothetically, but realistically, could it happen from here? We've had a bit of a downtrend ever since the middle of July, August, when it peaked. Could it collapse another 50% from current levels? Is that possible?
Yeah, I actually do believe that it will. In fact, I do think that we will have a correction. We will revisit the October lows probably next year in the first half. I think that trend line, again, we just talked earlier about the trend line that kind of connects these recent levels here that we've broken. So that's the beginning of this next phase to the downside. The first major stop will be the October lows. But I still think that within a year or so, we will test the COVID lows. And that would be an epic correction of about 50+%, 50 to 60% from the highs on the S&P 500.
When you say that a recession could last several years, and we talked about your thesis as to why, what does that mean for the markets? Are we going to get trailing, just sideways pattern, range bound for a couple of years as well, or could markets trade differently from the economic performance?
Yeah, so I think it's going to be a dance, right? It's going to be a dance between us analyzing every Fed statement, every decision, every CPI report. As the markets get into a recession and as we start to see the stock market come down, it's going to be more and more of this. Oh my goodness, when will the Fed print again? And so we're going to be hanging more and more on the Federal Reserve. It's almost like a drug addict, right? The stock market is addicted to this printing press that the Federal Reserve has enabled, and now we're being taken off that drug. And again, you're going to go through withdrawal. It's just natural where we've been addicted to it, and now we have to deal with it. So every time we think we're going to get maybe drugs, maybe if the markets just fall a little bit more, maybe the Fed will throw us a bone. That's going to be a scenario where you'll get big bounces. But in general, the trend to me is down. I think, again, you look back to the dot-com era, that was the last time you had this kind of insanity in the markets, and we saw how long that lasted. It lasted quite a while.
Well, let's flip over to Bitcoin. I'm curious to talk about, or get your thoughts on
Mhm.
BTC. Again, bit of a bounce since the beginning of the month. Well, actually, Bitcoin has been interestingly bouncing since the beginning of September. If you look at what it's done from the middle of September to I guess, the middle of or the beginning of October, it's actually traded in the exact, well, kind of the opposite direction
Hmm.
of the Nasdaq, because the
Yeah.
Nasdaq has been going down since the middle of September, while Bitcoin has been going up, and it's just in the last week that they've been kind of moving together. So this divergence has been on and off again this past couple of months. What's going on with the Bitcoin price pattern?
Yeah, so I think you're right here is that Bitcoin is slowly and slowly becoming kind of the inverse market where when stocks get a little bit scary, people do start to inch over a little bit towards the cryptocurrency side of Bitcoin. Everyone's assuming the BlackRock ETF and the ETF, the spot ETFs will get approved, which eventually I do agree with. So I think that this is where it's kind of this in-between period where it's kind of a gold, a digital gold, but it's kind of still a risk asset. And I say kind of still a risk asset because if you look at today, Bitcoin's down and we see the stock market down, right? So we see that correlation still holding. But then if you look at the bigger time frame, Bitcoin's been grinding up while the stock market's been a little bit more fearful and panicky. So I think there's this in between period. Initially, Bitcoin was 100% a risk asset. Slowly over time, and this will take years, Bitcoin will slowly move into more of a safety play versus kind of or with a digital gold or with gold. And I think we're seeing that in real time happening. It just takes a really long time. So again, I'm still in the camp that we could still see a big dump out on Bitcoins going forward. I'm worried that there's a head and shoulders pattern starting to develop here. We'll have to watch that very carefully over the next month or so. But if we break this 25,000 low here, we're going to go to 20. If 20 breaks, we're testing the lows on Bitcoin again. And I do worry that if panic really hits the market, selling becomes indiscriminate. And that's where you could see Bitcoin dump out. By the way, long term, huge advocate of Bitcoin. I love it. I just do think that going through this next tumultuous period in the financial system could be very troublesome early on for Bitcoin.
And you're not really bullish ahead of the halvening. Most people I've talked to, not most people, but a lot of people I've talked to who are bullish in Bitcoin cite the halvening next year as a bullish
Yeah.
event,
Yeah,
because
I'm
historically, yeah.
Yeah, so the have longer term. So having these events are fundamental. Fundamentals mean things over the long term. So long term, the less supply, the better. We know that. The reason I'm not super bullish because of it just alone and saying going into it is because historically a lot of the moves have come after that period, so people are kind of banking on making a lot of money. And the other thing too is what's very concerning to me is that if you go online and you talk to people, they're like, oh well, just buy it now and close your eyes and come back at the halvening and you'll be a millionaire. And I had trades like that in my early career, and every one of them I lost. It was like as soon as you think it's a done deal and it's a no-brainer, you're losing. You're going to lose money on that. So I still think longer term, absolutely, it drives price higher. I'm just skeptical that it's going to overpower fear and greed, and in this case, fear.
All right, I'll give you a hypothetical scenario. We've got 3 months left until the end of the month. Something is going to happen to change your mind to make you really bullish on stocks and Bitcoin. What is that thing?
Oh my goodness, you like throwing me these curveballs. Um, bullish on those. I don't know. Bullish on Bitcoin. The Fed starts printing nonstop again. I don't know if that would be a positive. I think longer term positive for stocks, but I do worry that if the Fed comes to that where they're having to print unlimited amounts of money, the economy is probably in a Great Depression, which then would be negative for stocks. But I would say at least for Bitcoin, any sort of printing of money, the reason for Bitcoin stands out even more.
Well, the last time we had really massive amounts of quantitative easing was, of course, during the pandemic, 2020 to
Mhm.
2021. Are you suggesting that, again, this is a hypothetical thought exercise. Are you suggesting that if the Fed were to resume that kind of activity, we would need a catastrophic event to the same level as maybe 2020?
Yeah, there's no doubt about it because think about this. If inflation is 3 to 4% right now and they went back to that type of printing, inflation would not go to 9% this time. It would probably go to 15 or 20%. And so that is the problem, is that's what we talk about the Fed being handcuffed, is that unless you get inflation back in the box and that's below 2%, and it's, how do you print the same amount? How do you ease and create that money supply, that M2 to flood back into the system? And I just don't see how they can do it unless it's a catastrophic situation where they literally have no better choice than to print money like that.
Last asset I want to cover today is oil. Oil is significant because it's really it's helped to drive up inflation, at least the headline CPI in the last couple of months. What's your read on the current price right now?
Yeah, going into today, I had bought oil right at this technical support. I didn't know what would happen in the Middle East, obviously, and again, horrific stuff there. But it worked out with the price popping up. The technicals aligned with that. This was a ton of support. Look at the trend line right here. I still think oil is going to go ultimately lower. I know I'm in the minority. I was in the minority when I said it was a short at 93. That played out beautifully there as well. But the key is this: is that globally, we know Europe's probably in a recession. China's in a bad spot as well. Most of the globe is already suffering. The US has been the one area where people have said, "Oh, maybe a soft landing, maybe no landing at all." I think that's a fallacy. I think that we will see a recession here in the US, and when that happens, prices have nowhere to go but down because of lack of demand.
Okay. Um, that's a fair point. And generally, whenever you see armed conflict anywhere in the world, Middle East, Europe, does that weigh down on your outlook for equities, risk assets overall?
Yeah, I mean, so it's a tricky one. Is sometimes the markets like to climb a wall of worry. In the scenario, it's more to do with oil, at least with the Middle East, right? And the issue there is that the U.S. now produces so much oil that the Middle East does not mean as much as it did. And I'm not talking about any scenario of what's going on in the ground. I'm just talking about how the markets view it, and so it doesn't have as big an impact, at least as of now. Now, if you have a lot of other countries get drawn in, that's a different story. But as of now, very little impact. And again, yeah, oil's up today, but in all fairness, it did just drop from 95 down to basically 82. So a bounce back to 86 is very standard in technical analysis. And I'll just mention this. I don't know if we were going to cover it, but you got to like the price action in gold here, guys. Gold again coming down, nasty sell off in the last couple of weeks, but came right into technical support. And the chart is still so bullish. I love this inverse head and shoulders that could be forming on gold. I still think, again, the more geopolitical instability out there, the more inflation holds on. Gold is the answer here.
Gareth, finally, let's talk a little bit about your strategies and your swing trading style for those of us watching who
Mhm.
may not know you. And I think there's new viewers to our videos every single time we speak. New audiences. What is your style in 1 minute or less?
So the style is called swing trading. It's basically holding anything less than a year. Most of my swing trades last between a week or two and a month or two, and it's basically taking advantage of key price disparities, right? So we just talked about oil. Oil fell into support, quick jump in, quick jump out. That was one of the quicker trades there on oil, but ultimately it's about just being nimble and using the charts to my advantage. I've traded again, like I said, for so long at this point that I've been able to master the charts, and I do give that to people. I give them exact entry and exits at inthemoneystocks.com for stocks and commodities, as well as verified investing is crypto.
And now, in verified investing education, what can we expect to learn from that?
Oh, verified investing education. That's at verifiedinvesting.com. And that's my 20 hours. Literally, I sat behind a computer and I recorded everything I know, everything that's in here for that many years. And the idea is, folks, is that literally I couldn't even count how much money I had to give up and how many years of my life I spent trying to learn how to trade the markets, accurately. And so all of that information, it's now in video format in my 3-course series, the Winning Trader series. And it's basically, you watch it, it will blow you away. I will go on record and say that it will blow you away with how much insightful analysis is basically be able to be taken and used to make money in any market.
Well, fantastic, Gareth. Follow Gareth in the links down below so you can learn more. I appreciate you spending time with us as always and walking us through this very volatile market and educating us. Appreciate it. We'll speak again next time.
Thank you so much, David. Take care.
Thank you, and thank you for watching. Don't forget to like this video and subscribe.